In September 2008, Federal Reserve Chairman Ben Bernanke announced an unprecedented monetary policy response to the global financial crisis. The Federal Reserve would purchase massive quantities of government bonds and mortgage-backed securities, injecting trillions of dollars into the banking system through a mechanism economists call quantitative easing. This policy was presented as innovative emergency monetary policy, a modern solution to a modern crisis. Financial media described quantitative easing as a sophisticated tool that only advanced economies with complex central banking systems could implement. But what if I told you that this modern monetary policy was actually invented over 2,000 years ago? That in 33 CE, during the reign of Emperor Tiberius, Roman authorities implemented what sources describe as the world's first documented quantitative easing program. What if the mechanisms Ben Bernanke used to combat the 2008 financial crisis were nearly identical to those employed by a 5-senator Roman commission in 33 CE? Welcome to Evolution Recognition. I'm your host, and today we're examining the Roman financial crisis of 33 CE through the lens of pattern recognition and historical analysis. This isn't simply a story about ancient economics. It's an investigation into how monetary policy mechanisms persist across civilizations and centuries. The evidence we'll examine comes from primary sources including Tacitus, Suetonius, and Cassius Dio, supplemented by modern economic analysis and historical scholarship. Our goal isn't to tell you what to think about modern monetary policy, but to provide you with analytical tools for recognizing how financial systems operate across different historical contexts. As we explore this historical episode, it's important to acknowledge that financial crises result from multiple interacting factors: legal, economic, political, and cultural. The Roman crisis of 33 CE wasn't simply a matter of government manipulation, but rather a complex interaction of individual choices, institutional frameworks, and cultural attitudes toward debt and state authority. What makes this investigation valuable isn't just understanding what happened in ancient Rome, but developing the analytical skills to recognize similar patterns in our contemporary world. By examining how Romans responded to financial crisis, we can better understand the mechanisms that shape monetary policy decisions today. Throughout this episode, we'll ask questions that encourage critical thinking. How do societies develop cultural acceptance of state financial intervention? What role do individual choices play in creating systemic financial dependency? How do crisis responses establish precedents that persist for generations? Our investigation begins in 33 CE in the heart of the Roman Empire, where a seemingly routine legal enforcement action would trigger a financial crisis that required unprecedented government intervention. Segment 2A, the legal enforcement trigger. To understand the crisis of 33 CE, we must first examine a law passed 84 years earlier. In 49 BCE, Julius Caesar enacted legislation requiring Roman moneylenders to invest in Italian farmland equal to their outstanding loan portfolios. Contemporary sources describe this as an attempt to prevent excessive speculation and ensure that Roman capital supported domestic agriculture rather than purely financial activities. However, historians note that this law was largely ignored for over 8 decades. Roman moneylenders continued their lending practices without purchasing the required farmland, and Roman courts made no systematic effort to enforce compliance. This created what modern economists would recognize as a regulatory forbearance period, a time when authorities choose not to enforce existing laws. In 33 CE, during the reign of Emperor Tiberius, Roman authorities suddenly began prosecuting violations of Caesar's farmland law. Primary sources don't provide definitive explanations for why enforcement began at this particular moment, though historians suggest multiple contributing factors including fiscal pressures on the imperial treasury, political tensions within the Roman elite, and changing attitudes toward financial speculation. The decision to enforce this long-dormant law wasn't simply an administrative action, it represented a fundamental shift in how Roman authorities approached financial regulation. Contemporary accounts describe widespread prosecutions of moneylenders who had operated for decades without purchasing the required farmland collateral. Recognizing the potential disruption this enforcement could cause, the Roman Senate granted an 18-month grace period for compliance. Moneylenders would have a year and a half to purchase Italian farmland equal to their loan portfolios or face continued prosecution. What sources describe as a reasonable accommodation would actually trigger the most severe financial crisis of Tiberius's reign. Segment 2b, the Financial Cascade. The 18-month compliance period created what modern economists would recognize as a classic liquidity crunch. Roman moneylenders faced an immediate problem. They needed to acquire large quantities of cash to purchase farmland, but their wealth was tied up in outstanding loans that weren't scheduled for repayment for months or years. Contemporary sources document the cascading effects that followed. Moneylenders began calling in loans early, demanding immediate repayment from borrowers who had expected to repay over extended periods. Borrowers who couldn't meet these sudden demands were forced to sell property quickly to raise cash, creating what historians describe as fire sales of real estate throughout the Roman territories. The sudden flood of property onto the market drove down real estate values, which created additional problems for the financial system. Many loans were secured by property that was now worth less than the outstanding debt. This meant that even borrowers who sold their property couldn't fully repay their loans, leaving moneylenders with losses that further reduced their ability to purchase the required farmland. As property values declined and loan defaults increased, some Roman banking houses began failing entirely. Sources describe a credit contraction where surviving lenders became increasingly reluctant to make new loans, preferring to hoard cash for farmland purchases. This reduced the availability of credit throughout the Roman economy, affecting not just financial speculation, but also legitimate commercial activities. The combination of reduced credit availability and increased demand for cash drove interest rates to what contemporary sources describe as unprecedented levels. Borrowers who could still obtain loans faced dramatically higher costs, while many potential borrowers found credit entirely unavailable. The financial crisis began affecting the broader Roman economy as merchants struggled to obtain credit for trade. Property developers couldn't finance construction projects, and even wealthy Romans found their assets tied up in illiquid investments. What had begun as enforcement of a single law was creating systemic economic disruption throughout the empire. By late 33 CE, the crisis had reached a scale that demanded imperial attention. Contemporary accounts describe Tiberius receiving reports of widespread financial distress, banking failures, and economic disruption that threatened the stability of Roman commerce. The emperor faced a choice: allow the crisis to continue and potentially destabilize the entire Roman financial system, or intervene with unprecedented government action. Segment 3A, the Five-Senator Commission. Tiberius's response to the financial crisis represents what historians describe as unprecedented government intervention in Roman credit markets. Rather than allowing market forces to resolve the crisis through continued bankruptcies and economic contraction, the emperor chose direct state action to restore financial stability. Primary sources document that Tiberius appointed a five-senator commission with extraordinary authority to address the financial crisis. This wasn't simply an advisory body. Contemporary accounts describe the commission as having operational control over a massive government lending program designed to inject liquidity directly into the Roman financial system. The scale of this intervention was enormous by Roman standards. Sources document that Tiberius provided the commission with 100 million sestertii for lending operations. To put this in perspective, historians estimate this amount represented approximately 10% of the entire imperial treasury's annual revenue, equivalent to the United States Federal Reserve deploying roughly $400 billion in emergency lending during a single crisis. The Commission's lending terms reveal sophisticated understanding of monetary policy mechanisms. Contemporary sources describe the loans as interest-free for 3 years, what modern economists would recognize as a zero-interest rate policy designed to encourage borrowing and restore credit market function. However, these weren't unsecured loans. Roman authorities required borrowers to provide agricultural land worth twice the loan amount as collateral. This created what modern financial analysts would recognize as asset-backed securities, loans secured by real estate that could be seized if borrowers defaulted. The parallels to modern central banking are striking. Just as the Federal Reserve creates emergency lending facilities during financial crises, providing liquidity to banks at favorable rates secured by various forms of collateral, the Roman Commission provided emergency liquidity to moneylenders at zero interest rates secured by real estate collateral. Segment 3B, Monetary Mechanisms Analysis. When we examine the mechanisms of Tiberius's intervention alongside modern quantitative easing programs, the similarities become apparent. Both involve government authorities injecting large amounts of money into financial systems during periods of credit contraction. Both use favorable lending terms to encourage borrowing and restore market confidence. Both require collateral to secure government funds against potential losses. Modern quantitative easing operates through central bank purchases of government bonds and other securities, expanding the central bank's balance sheet and increasing the money supply. The Federal Reserve's balance sheet expanded from approximately $900 billion in 2008 to over $4 trillion by 2014 and reached nearly $9 trillion during the COVID-19 pandemic response. The Roman intervention operated through direct lending rather than securities purchases, but the monetary effect was similar. By providing 100 million sestertii in new loans, Roman authorities effectively increased the money supply and restored liquidity to credit markets. The three-year term of these loans meant this monetary expansion would persist long enough to allow financial markets to stabilize. Modern central banks purchase various types of assets during quantitative easing programs: government bonds, corporate bonds, mortgage-backed securities, and even equity securities in some cases. The Roman Commission accepted agricultural land as collateral, effectively creating a market for land-backed lending that hadn't existed before the crisis. Both ancient and modern interventions used interest rate policy as a primary tool. The Roman Commission's zero interest rate policy for 3 years parallels the Federal Reserve's near-zero interest rate policies maintained for extended periods following the 2008 financial crisis and the 2020 pandemic response. Perhaps most importantly, both interventions relied on psychological effects as much as direct financial mechanisms. By demonstrating government willingness to provide unlimited liquidity during crisis periods, both Roman and modern authorities sought to restore market confidence and encourage private lending to resume. The Roman intervention established institutional precedents that would persist throughout imperial history. Future emperors would reference Tiberius's crisis response as justification for similar interventions during subsequent financial disruptions. This created what historians describe as an expectation of government support during financial crises, a moral hazard that encouraged risk-taking by private lenders who believed the state would intervene if their activities created systemic problems. Modern financial systems exhibit similar moral hazard effects. The expectation that central banks will intervene during financial crises encourages banks and other financial institutions to take risks they might otherwise avoid. This creates what economists call the too big to fail problem, where large financial institutions operate with implicit government backing that distorts market incentives. Segment 4A, Historical Continuity and Precedent. The Roman crisis of 33 CE established patterns that would repeat throughout history whenever governments faced the choice between allowing financial systems to collapse or intervening with public resources. What makes this episode particularly significant isn't just its early date, but how clearly it demonstrates the mechanisms that would become standard features of state financial policy. The Five-Senator Commission created institutional frameworks that persisted long after the immediate crisis ended. Roman law developed concepts of emergency government lending, collateral requirements for public funds, and imperial authority over credit markets that would influence legal systems for centuries. These weren't temporary crisis measures. They became permanent features of how Roman authorities approached financial regulation. Perhaps more importantly, the crisis response changed Roman cultural attitudes toward government involvement in financial markets. Before 33 CE, Romans generally expected financial problems to be resolved through private mechanisms: bankruptcy, debt forgiveness, or market adjustment. After Tiberius's intervention, there was growing expectation that government should act to prevent financial collapse. This cultural shift didn't happen without individual participation and choice. Roman moneylenders chose to accept government loans rather than face bankruptcy. Roman borrowers chose to participate in a system where government backing reduced their perceived risk. Roman citizens gradually chose the security of government financial intervention over the uncertainty of pure market mechanisms. Over time, what sources describe as Roman financial culture evolved from principles of individual responsibility and market-based risk assessment toward increasing reliance on government intervention and state-backed financial security. This wasn't imposed from above. It emerged through countless individual decisions by Romans who found government-backed financial systems more attractive than purely private alternatives. Segment 4B, Modern Applications and Parallels. The 2008 financial crisis provides the clearest modern parallel to the Roman experience. Like the Romans, American authorities faced a choice between allowing financial institutions to fail or intervening with unprecedented government support. The Federal Reserve's response included many of the same mechanisms Tiberius employed: emergency lending facilities, favorable interest rates, asset-backed securities, and massive expansion of government balance sheets. Modern quantitative easing programs operate on scales that dwarf the Roman intervention, but the underlying logic remains identical. Central banks inject liquidity into financial systems during periods of credit contraction, use favorable lending terms to encourage borrowing, and accept various forms of collateral to secure public funds against losses. American cultural attitudes toward Federal Reserve intervention have evolved similarly to Roman patterns. Before the 20th century, Americans generally expected financial panics to be resolved through private mechanisms. The Federal Reserve's creation in 1913 began a gradual shift toward expecting government intervention during financial crises. Modern Americans participate in this system through countless individual choices. We choose to use banks that operate with Federal Reserve backing rather than purely private alternatives. We choose to invest in markets that benefit from central bank intervention. We choose to support political candidates who promise to maintain government financial safety nets rather than those who advocate pure market mechanisms. Both Roman and modern systems create what economists call moral hazard, the tendency for individuals and institutions to take greater risks when they believe someone else will bear the costs of failure. Roman moneylenders became more willing to make risky loans after Tiberius demonstrated government willingness to provide emergency support. Modern financial institutions exhibit similar behavior, taking risks they might otherwise avoid because they expect central bank intervention during crises. The long-term consequences of these patterns raise important questions about financial system sustainability. Roman reliance on government intervention contributed to fiscal pressures that persisted throughout imperial history. Modern central bank interventions have created debt levels and asset price distortions that many economists consider unsustainable over extended periods. The Roman crisis of 33 CE provides us with a framework for recognizing how financial systems respond to crisis across different historical periods. When we examine monetary interventions, whether ancient or modern, we can look for several consistent patterns that help us understand the underlying mechanisms at work. First, examine how crises begin. Both the Roman crisis and modern financial crises often start with enforcement of existing rules or regulations that had been previously ignored. The sudden application of dormant legal requirements can trigger cascading effects throughout financial systems that depend on regulatory forbearance for their normal operations. Second, analyze the mechanisms governments use to respond to financial crises. Whether through direct lending, asset purchases, interest rate manipulation, or balance sheet expansion, authorities tend to use similar tools across different historical periods. The specific institutions may change, but the underlying monetary mechanisms remain remarkably consistent. Third, consider how individual choices and cultural attitudes contribute to both crisis development and response acceptance. Financial systems don't operate independently of the people who participate in them. Understanding how individuals choose to engage with government-backed financial mechanisms helps explain why certain policies become politically sustainable while others face resistance. Fourth, examine how crisis responses establish precedents that influence future policy decisions. Emergency measures often become permanent features of financial systems, creating institutional frameworks that persist long after the original crisis has ended. This pattern appears consistently across different civilizations and historical periods. Rather than telling you what to conclude about modern monetary policy, we encourage you to apply these analytical tools to contemporary financial systems. Consider these questions as you observe current economic policies and their historical precedents. How do your personal financial choices contribute to the systems you observe around you? When you choose to use banks with government backing, invest in markets supported by central bank intervention, or support political candidates who promise financial security, how do these individual decisions collectively shape the financial systems we all participate in? How have cultural attitudes toward financial risk and government intervention evolved during your lifetime? What factors influence whether societies choose market-based solutions or government intervention when facing financial challenges? How do these cultural preferences develop and change over time? When you observe modern financial policies, can you identify the mechanisms we've discussed today? Do you see patterns of crisis response that parallel historical examples? How do contemporary authorities justify interventions that might have been considered inappropriate in earlier periods? What are the long-term implications of the financial policies you observe today? How do current interventions compare to historical examples in terms of scale, duration, and potential consequences? What lessons from past financial systems might inform our understanding of contemporary challenges? This is why evolution recognition exists. We're not here to advocate for specific political positions or tell you what to think about modern monetary policy. We're here to provide you with analytical tools that enable independent critical thinking about the patterns that shape our world. By understanding how financial mechanisms have operated across different historical periods, you develop the ability to recognize these patterns in contemporary contexts. This knowledge empowers you to make more informed decisions about your own participation in financial systems and your evaluation of policy proposals. The Roman experience reminds us that financial systems reflect the collective choices of individuals who participate in them. Neither ancient nor modern monetary policies operate independently of cultural attitudes and individual decisions. Understanding this relationship between personal choice and systemic outcomes is essential for anyone who wants to engage thoughtfully with financial and economic issues. The patterns we've examined today appear throughout history in various forms. By developing skills for recognizing these patterns, you become better equipped to understand not just financial systems, but the broader mechanisms through which societies organize economic relationships and respond to challenges. If this analysis has provided you with useful tools for understanding financial systems across history, subscribe to Evolution Recognition and engage with our community of critical thinkers. We're committed to providing educational content that empowers independent analysis rather than promoting specific political conclusions. The Romans believed their financial innovations would provide permanent solutions to economic challenges. History suggests that no financial system, ancient or modern, provides permanent solutions to the fundamental tensions between individual choice, collective security, and long-term sustainability. Understanding these tensions through historical analysis enables more thoughtful participation in the ongoing evolution of economic systems. Until next time, keep questioning, keep analyzing, and remember, those who understand historical patterns are better equipped to navigate contemporary challenges. Thank you for joining Evolution Recognition.